Hello.
Hello, everyone. Good afternoon. We are excited to do our Fund 2 webinar summary. Very excited about all of the assets that are owned by Fund 2, the assets that are under contract in Fund 2, making sure that everyone has a great understanding of how Fund 2 works and the infinite rate of return model and our targeted projections for Fund 2 and the assets in Fund 2. Excited to have a live audience join us today, a bit smaller than usual because we're doing this at noon instead of our usual evening time. We will run this a little bit differently in that we will hold all of our questions until the end. Our goal here is to solve the problem that we have as we're talking with investors, and so much activity has happened in Fund 2. We've had 5 amazing acquisitions. Many of those, the renovations are already starting. We're having new leases placed. We're already part of the way through our business plan. We also have 2 assets under contract. There's a lot of information to share, and depending on when someone maybe first learned about the fund, they may not know of all of the acquisitions that are in the fund, or they're not exactly sure how infinite rate of return model works. And to date, we don't have one centralized place for that. So that's our goal with this time together, is to do a fast but deep overview of Fund 2, the structure of it, the assets that are already in the fund, and then talk about the 2 assets that we have under contract and our plans for the additional capital that's in Fund 2. And then we will answer questions at the very end. So let's get started.
So if you caught our first Fund 2 webinar, this is going to be kind of the perfect bookend to that. And then if you're just thinking about making your first investment in Fund 2, have just heard about Fund 2 for the first time, this is going to be a kind of a tight, 1-hour presentation that'll hopefully give you, all the relevant details you need to know to make a good investment decision about Fund 2.
Absolutely. So this is Black Swan Real Estate Fund 2. I'm Dr. Elaine Stogberg. This is my husband, Nick Stogberg. We are the GPs of the fund. We've been running Black Swan Real Estate for about 12 years. This is the business model that we've used for all of the real estate deals we have ever put together. Going back all those 12 years, we've never sold a single asset, and we now do this in a private equity fund model. We're in Fund 2.
Couple of
course, our
disclaimers.
Go ahead.
There's going to be some, pro formas, projections for the future. Just know that, those are merely that. You should, consider these investment decisions. Speak with your advisors. We're not attorneys. We're not accountants. We're going to talk about some of our past performance, but we always want to mention that, past performance does not necessarily correlate to future outcomes. So all of our usual general disclaimers, and then our financial disclaimer as well. So again, speak with your advisors and make sure that you're making the most well-informed investment decision that you can with any investment that you're going to potentially consider.
Absolutely. If you're interested in investing in Fund 2, you can find the PPM and the operating agreement on blackswanfund2.com. That uses the InvestNext portal. It's an ultra secure portal specifically for funds, so blackswanfund2.com. If you would like to schedule a call with us or get any of our other newsletters, information, ways to reach us, meetblackswan.com is the way to do that. Our calendars are getting rather booked up here toward the end of the year. So if you are not able to find a time on our calendars on the Calendly link, you can email us, Nick at Black Swan Team or Elaine at Black Swan Team. That's the best way to reach us. You can also try giving us a call. Our numbers are there on the slide. The deadline for Fund 2 is December 23rd. So we want to make sure we're making ourselves as available to you as possible to have those calls, answer any questions. So please do try to schedule a time on Calendly, but if you're unable to do that, feel free to reach out to us directly. A little bit more about us. As I mentioned, we're Nick and Elaine Stogberg. These are some of our beautiful children here. We're a family-owned business. Nick and I started investing in real estate 12 years ago. We were what you would consider to be accidental landlords. We both owned homes before we got married. We moved into Nick's home, rented out my home, and then we grew. And as we grew, people came to us and asked if they could join in what we were doing. So now we have a little over $300 million in assets under management in our private equity funds and in our other JV opportunities that we historically had. We're very vertically integrated. So we manage everything that we own and we only manage what we own. So that's our property management company, Black Swan Living. We really think of ourselves as operators. We really think of ourselves as property management first. And we really believe that most of the value that we create comes from our renovations and our management. And so of course we keep that in-house so that we can drive consistency, quality, and the control that we want to be able to deliver the returns that we're targeting. We've raised over $60 million in capital from our joint ventures and our private equity funds. We have a large real estate sales team as well. So we had 75 million in sales in 2021. We'll have about 100 million in sales in 2022. That allows us a seat at the table of Gary Keller's personal mastermind. And we're just so grateful for the opportunity to learn from one of the greats in the industry. And then we also do ground up construction. So there's no ground up construction in Fund 2, but we do have expertise in ground up construction. We're building a 115 unit townhome community about 5 miles outside of Rochester. We've been working on that for the last several years and intend to continue to do ground up construction in the future as well. Anything you want to add?
Like the ground up construction forms one of the deals in Fund 2. We're going to build between 9 and 14 urban core townhomes in the main floor space in that building. We have about 65 in-flight job sites right now for renovations. So just, I would say the whole thing really informs our expertise, our ability to buy these assets, to renovate these assets, or, in some cases to do kind of, such extensive remodel, it might as well be a ground up construction project. We love what we do. And we just crested that magical $350 million AUM. That's a fun sounding number there.
Yeah.
Just over 1,000 doors and just over $350 million in assets under management. So that's a fun, fun kind of number to be able to say out loud.
And it really helps us to get the economies of scale that we need. The contracts with like our subcontractors, materials, so many things come together having that many assets under management. Again, that we not only asset manage, but that we property manage. We're really able to drive a lot of efficiencies as we've reached this size.
Yeah, we were able to negotiate a contract with our internet provider that there's no way we could have negotiated such an incredibly favorable contract if we didn't have 1,000 doors to kind of have as leverage in that negotiation. That contract alone will create millions of dollars in value for the assets that are affected by that contract. Whereas if we just had one apartment building we were trying to negotiate a contract for, we wouldn't be able to create that millions of dollars in value. The economies of scale when you get to 1,000 doors provide really interesting opportunities.
Absolutely. Let's talk specifically about the details for Fund 2. So Fund 2 is a $30 million fund. It's very different than a typical syndication or private equity fund. So I find that when people are trying to compare kind of apples to apples, maybe sometimes the understanding of Fund 2 breaks down. So I just encourage you to think of Fund 2 as really its own kind of investment opportunity. So the first thing is there's no fees whatsoever, none. There's no asset management fee, no acquisition fee, no capital event fee, loan recourse fee, disposition fee, on and on. We believe as general partners that fees disalign incentives between GPs and LPs. And so we just simply choose not to participate in fees. For Fund 2 so far this year, that has been about $1.2 million of fees that we have waived. That's the first way that our fund is very different. The second way is 100% of all profits from cash flow or cash out refi proceeds go back to our investors until they're completely repaid. So we collect no split, no profit whatsoever until our investors are completely repaid. Again, we just think that's the right thing to do. We've always operated that way. I think that's particularly important when there's any type of choppy waters in the economy, because obviously every dollar that our investors are getting back, they're moving more and more towards security until they have $0 left in the fund. And then the third difference that's really the biggest difference is our investors stay in the deal forever. So many funds or syndications exist where the general partners will do a cash out refi and then pay out the investors, and then they're out of the deal, and then the general partners continue to own that real estate. And in our model, our partners stay in forever. So we're targeting about a 20 or 25-year hold period that we will own these assets together. And again, we think that's the right thing to do. It's a 50-50 split during that infinite rate of return period. Again, it's a long-term hold, but I just want to really stress that all of your capital comes back in the first 5 years. We target a payback period of 5 years or less. We tell people to plan for a 5-year period. Historically, it has never taken us that long. It has never taken us 5 years. 3 years is a more normal time frame. So you have all of your original investment back, and yet you stay in the fund for the next 20 or 25 years while we own those assets. And that's when you get that infinite rate of return period. This is a Reg D 506C available to accredited investors only with a $100,000 minimum. And then I'll let you talk about our charity and our profit share, because I know you're super fond of those.
That's our favorite thing. You know, our big vision here is to change capitalism in some small way, to change capitalism in a way Warren Buffett changed capitalism with the Buffett pledge. You know, you can't keep it. You have to give it away. Imagine a world where every single private equity fund had a 5% give back. Like, you could rebuild every school in the country every year. It's not such a big number that it has a material impact on the profitability for the general partners, but it's still a significant amount of money that could change the world. So we would love to have $1 billion in assets under management, and 5% of all the profit from that goes to charity. We've done some really cool things. This past year, we helped a school. We converted a 40,000 square foot abandoned office building to a school, and the kiddos just moved in here a few months ago. It's certainly, I feel like, the coolest thing I've ever done in my life, and I can't take much credit for it. There's so many people that were involved in that effort, but Elaine and I got to bring our real estate expertise, as well as a significant amount of money as well to assist with that effort. And that's where those charity dollars go, is to really fund cool things like that. We're helping local homeless shelter, Dorothy Day, upgrade their kitchen from kind of a residential kitchen to a commercial grade kitchen. Just helping out with cool things that are kind of in our area of expertise, so to speak. And it'll be a significant amount of money over the long term, over the next 20 years. This will be hundreds of thousands of dollars that will go to support really cool things. And then 5% of our profit goes to support a profit share for our staff as well. So whenever our staff, our property management staff, are walking the properties, they know that they own a piece of this building. They are invested in this building in the most tangible sense of the word. And we love that alignment of incentives. We're not aware of any other private equity funds that have a give back, that have a profit share with their staff. And we would love to change the game in some small way if we're successful.
Absolutely. It's important to talk about tax benefits of the investment as we near this time of year. So 2022 is the last year that real estate is eligible for 100% bonus depreciation. So of course we'll be doing cost segs, bonus depreciation, accelerated depreciation, everything we can to get the most amount of depreciation for 2022. And many of our investors will kind of tailor their investment amount based on any tax needs that they have. So if that's a concern for you, feel free to block a time, ask questions. We're not, accountants or advisors or anything, but we have a lot of investors that specifically want to talk about the tax benefits of the fund. So just know that we're working really hard on getting the maximum amount of depreciation possible. That will all go out on 2022's K1. And so there are significant tax benefits to the fund as well. We talked about figures that aren't in the fund, so that's fees. You can see here, the list of fees that we do not collect. In terms of fees waived in Fund 2 thus far, it's a little over 1.25 million. And you might be asking, like, well, why do we do that? Number one, we do it because we think it's the right thing to do. We really don't think that general partners should have an opportunity for income that's completely separate from the limited partners. We think general partners should only profit the same ways that limited partners do, and at the same time as limited partners. And then also it really helps with our payback period. So if our goal is to get all of your capital back to you as quickly as possible, that's that payback period. That's your goal, because that gets you to an infinite rate of return period as quickly as possible. That's our goal, because we don't profit at all until we've hit that benchmark. And every dollar that we would take out in fees would slow down that for all of us. And so it serves the business model really well, in addition to being the right thing to do. Why an indefinite hold period?
Yeah, so this is there's a lot of slides we could spend a lot of time, kind of talking about from our Fund 2 launch webinar. This was, I would say the most important slide, or one of the most important things to understand about our fund. So most private equity funds, most real estate syndications are a short hold period business model, typically 5 years. And then if they're able to, hit their 5-year business plan in 2 years, they would sell that asset in that time frame. And there's lots of reasons for that. Typically there's this, kind of compensation structure that incentivizes keeping that hold period synthetically shorter to kind of synthetically boost your rate of return. But I have to ask the question: if a deal is going amazing, if it's generating tons of profitability, if that apartment building is becoming more valuable very quickly, why would you want to sell it? Why would you want to kill that golden goose? And so we have a BRRRR business model. We target an indefinite hold period. We've never sold an asset in all the time that we've done this, and we think you should keep that golden goose. So we refinance it, which is a lot harder than selling that asset. When you sell that asset, you're able to realize, 98% of that asset value. When you do a cash out refi, you might be realizing 75 or 80% of that asset value. So it's a harder target for us to hit to return capital to our investors, to get a return to our investors in the short term. But in the long term, we think it's better for everyone. It's better for us. It's better for our capital partners. And ultimately, it's better for the community. It's better for the tenants. We've looked at apartment buildings where that apartment building has changed hands, 5 times in the last 10 years. Every other year, there's a new ownership group, a new property management group that's trying to do a new, value add plan to that apartment building. Like, how much better would it be for that block, for the people living in that apartment building, if it was just one ownership group for the last 10 years? And that informs everything that we do. So it's common to see, syndicators or funds that will do kind of lipstick remodels. They'll repaint old laminate countertops. They will, and sometimes it's not even the first time those countertops have been repainted. They'll repaint old cabinets. They'll repaint old bathtubs. And, after a couple of years, that paint starts to peel off, the rehab starts to wear out, and they need to sell that asset, get that hot potato out of their hands. We rip out those old cabinets. We rip out those old countertops. We put in new premium solid wood cabinets and, 3-centimeter premium quartz countertops that'll last for 50 years. And in the short run, it's less profitable to do that deep value add. But 5 years from now, when we don't have to, repaint those countertops again, and 10 years from now, and 20 years from now, when we still have those same beautiful stone counters, we're going to thank ourselves, and our rate of return is off the charts. We're making an investment in the community. We're making an investment in the tenants. We're making an investment in the future when we do these deep value adds. And then finally, some of the more sophisticated investors, this is kind of the first thing that they latch onto, is the huge tax advantages of this business model. So we're not particularly clever. We haven't found some loophole in the tax code. The IRS aggressively incentivizes providing food and shelter. If you are a flipper, the IRS penalizes that. You're going to pay, huge taxes on that sale event. If you buy, renovate, and hold long-term market rate affordable rental housing, the IRS subsidizes the heck out of that. The IRS wants to keep the cost of shelter low. So if you invest in our fund, you're able to benefit from a windfall of depreciation. We're frequently able to return capital basically with little or no tax consequences to you. You can put that capital into the next fund, get more depreciation out of that fund, invest in the next fund, and all we have to do is hold that asset from the first fund. If you've invested in syndications, that you get this huge windfall of depreciation year 1, but maybe the asset sells in year 2, and all of a sudden you have to recapture all that depreciation and pay a capital gain, and you have this huge tax event, this huge tax liability. You're kind of scrambling to get more depreciation to fill that void, but maybe you don't get a deal, and now you have this huge tax bill. So when you look at a risk adjusted, tax adjusted return basis, this is the best business model. It's harder. It's harder for us to achieve really high returns, getting to an 80% or 75% cash out refi versus 98% sale, but it's in the long run, it's just such a better business model from every aspect that we look at it. So that's why we target an indefinite hold period.
Absolutely. Let's talk about how the fund worked. Nick just summarized it quite well, but I'll go over it again just to make sure there's a clear understanding here. So in the first several years, that's when we are raising the capital, we are acquiring properties, and then most importantly, we are doing significant renovations. And with those renovations comes vacancy as well. So in that first, let's say, year, that's when we're really putting the capital to work. We don't anticipate any distributions in the first year. After properties start to stabilize, some of those renovations get complete, people move in at the new higher rents. Starting in about mid-year 2 is when we anticipate we will start doing distributions out. And again, that's return of capital. So every dollar you're getting back is returning your original investment. Around year 3 or 4 is when we really start looking at that cash out refi time period. So the properties have been either fully renovated, or if it's a large enough renovation, sometimes we will do phased renovations and do multiple cash out refis along the way. But we're at a place where we have enough equity created that we can do a cash out refi, and then we return the bulk of the capital all at once. And at that point, you have $0 left in the deal. Again, we tell people to plan for 5 years. Historically, it's never taken more than 3 years. And then you're in an infinite rate of return model. And then from years 5 onward, or from that payback period, whatever time that is, from that time onward is that infinite rate of return, and you'll get quarterly distributions of all of the profits. So in some years, it will be just from cash flow of the assets. In future years, there will be future cash out refi events. And of course, you would participate in all of that. And then at the very end, about 20 or 25 years from now is when we'll look to sell all of the assets, liquidate them, send out all of the final equity payments, and then officially close the fund. People ask about that timeline. That's literally just created off of our lifespan, the lifespan of the investors that we have in the fund. And we don't give ourselves a specific window because we can't predict what might be happening in, say, 2042. But around that time period, we'll start looking at what is the best time to liquidate these assets. What's a time where real estate values are high. In terms of numbers, there's a very simplified projection here. A couple of things to note is this is based off of past results. There's no guarantee of this, performance happening in the future, but it's what we've done for the last 12 years with all of the deals that we've ever put together. And all of the numbers here, we're speaking in today's dollars. So we are not including organic income growth in these numbers. And that's really important to note. So for example, when we talk about like $100,000 in year 20, it's likely that that will actually be $200,000 in 2042. But we really think that the human mind is best designed to think about money invested today and then what the returns would be today without organic rent growth.
Yeah. So from a really high level perspective, in year 1, you may not get any capital back as we're investing capital, running our value add plan, turning over units. In years 2 and 3, maybe you'll get 10% of your capital back. So if you put in $1 million, you might get 100,000 back each year. If you put in 100,000, you might get 10,000 back each year. And then as we get to the end of year 3, hopefully we're hitting cash out refis on some of these assets. And maybe at the end of year 3, you get, 70% of your invested capital back. So at this point, you're at the end of year 3, you've gotten 90% of your capital back. Maybe that following year, you get the remainder of the capital, and you're in that infinite rate of return. This cycle then repeats itself. So in most fund structures, eventually the investors are cashed out. So they hit some, maximum return figure, something like that. There's no such thing in our fund. You are in this fund forever, as long as the fund lives, as long as these assets are still owned by the fund. So, 15 years from now, we might be hitting our 3rd or 4th cash out refi. You're still going to benefit from that, that big bolus of capital. So there'll be some years where you'll get, small amounts of capital, and then other years where you'll get big boluses of capital. And then, 25, who knows how many years from now we sell these assets, and you benefit in that windfall as well when those assets are ultimately sold. So that's what that capital return and return on investment profile potentially looks like. This is just a projection. Future results may vary. It's possible that you could find another operator, somewhere in the country, another syndication that has a better deal than us. Maybe they can do a better renovation than us. They can get a better purchase price on the buy or the sell or something like that. But mathematically, it should intuitively just make sense to you that, we're not aware of any opportunity out there that gives you a better, kind of mathematical split, so to speak. No fees, and 100% of the profit from the venture goes to you until you get a full return of capital. So, if times are good and we're able to, get a full return of capital in 2 years, your rates of return are just absolutely staggeringly off the charts, amazing. And, if it takes 5 or 7 years to return capital, we're in a situation where it's not impossible to lose capital with this approach, but it's really difficult. Whereas if you were in another model where, a different syndication where they were required to exit at the end of 5 years, and there's a downturn in the real estate market 5 years from now, it is possible to lose capital with an investment like that. So when times are good, when times are bad, this is a model that really optimally protects you, our capital partner in the business. In all the years we've been doing this, we've never lost investor capital. We've never lost our own capital. We've never, failed to return capital or failed to make an expected payment to a lender. So we're very good at this. We've done this for a long time. We think we've put together a model that really puts the investor first.
Absolutely. So that is the structure of Fund 2. That's how it works, the timelines that we're discussing, the projected returns that we're discussing, all of the unique things about our fund, our track record. And now we'll jump into the assets that are already owned in Fund 2. So we already have 5 assets that have closed, and we have 2 additional assets that are under contract.
Yeah. So we've got Tenaraville Apartments. That's kind of the cornerstone of the fund, where we're putting the most amount of individual capital in a particular investment opportunity. Residences of Old City Hall, the former City Hall of Rochester. We're gonna kind of dig into details on each of these assets here in just a moment. Hampton's Townhomes, a smaller deal that just is a no-brainer, amazing return deal that we're able to drop into the fund. That's the really magic thing about the fund. Douglas Trail Townhomes, an incredible deal, a Section 42 affordable housing deal that's already yielded incredible returns. And then Riverview Apartments, a $5 million deal. We just closed on Douglas Trail and Riverview, and then we closed on City Hall Hamptons 6 weeks ago or 8 weeks ago maybe now, and Tenaraville maybe 10 weeks ago. So these are all the assets that we've already closed on, and we've got a couple more coming up.
We'll do a bit of a deep dive here into Tenaraville. So Tenaraville is in Tacoma, Washington. That's our second headquarters. It's 130 units built in the 1970s. If you have a chance and you're able to look at your computer, the bottom picture here really shows for you what we love about Tenara. So there's several 2-story buildings that all face into a rather large lawn. And if Tenara was built today, the lawn would not be this size, it would be much higher density. So this lawn is very, very valuable, and it's very underutilized as just grassy space right now. So in addition to doing an exhaustive renovation of every single unit, every single interior common area, every single exterior piece, like painting everything and redoing windows, all of the exterior stuff, we're also doing several $1 million of landscaping out here to make this a shared outdoor living space with things like grills, pergolas, seating areas, yard games, all of the things that will really make this not just a great apartment to live in, but a great community to live in. So very excited about that. We acquired this at about a little over $24 million. We have a number of different pro formas that show at least $36 million in value after our renovations are complete. And then depending on our modeling or how far we go with our renovations and as the area rises, I'll let Nick talk about why we love this area overall. Some of our projections are 40 million plus, so a staggering amount of value through these renovations. And we modeled this after a different community that we own in Tacoma, just a few miles away. That asset is not in the fund, but it informs the fund. It's Garden Court West. We acquired that about 15 months ago. Very similar construction style, very similar area with a shared courtyard in the middle. And we've done exhaustive renovations there. We acquired that at $9.8 million, and we just had that appraised just a few weeks ago. What was the appraisal?
So our as complete appraisal is 19 million. And then our as is appraisal, and that's, keep in mind, this is like a huge in progress job site, was 15 million. So we've more or less doubled the value of that asset here in a little over a year. And it's as is value, it's an off the charts, return on investment here. When we took over that asset, rental rates were below $900 a month. Our leases today are at $1,900 a month. I think our next lease is going to go out over $2,000 a month. So it's just been an incredible transformation, the most dramatic transformation I think we've ever achieved to date. And Tenara is just, replicating and kind of doubling down on that success that we've had at Garden Court West.
Absolutely. Why don't you talk about our love of Tacoma overall and Point Ruston?
Yeah. So we perceive this to be one of the, largest transition stories that's happening in the entire United States. So we, fly all over over the place. We see lots of markets to invest in, and Tacoma is one of our favorite markets in the entire country. So Tanara Villa is 1.6 miles from Point Ruston. Point Ruston used to be one of the largest, it was the largest copper smelting facility in the world for half a century. It eventually became an EPA, Superfund cleanup site. Well, that cleanup effort, went extraordinarily well, and it is now a multi-billion-dollar master plan community. It's the nicest piece of real estate I've ever seen in my entire life. It has an ocean-going vessel as a community amenity. Just an unbelievably nice community. And then there used to be just miles and miles and miles of workforce housing that was created in the 60s and 70s around this, kind of industrial area. And today you have, information workers working at Amazon and Microsoft that are commuting from Tacoma to Bellevue to Seattle to work. So it's gone from kind of an older demographic to a very young demographic, and you're seeing just an incredible transformation as the path of progress moves south. So whatever you can conjure up in your imagination of we're buying a apartment complex that was once a 55 plus community and is now 1.6 miles from the nicest piece of real estate I've ever seen in my entire life. Whatever you can kind of conjure up in your mind is pretty accurate. There's really unlimited upward potential in this particular asset. There's now, multi-million-dollar homes that are across the street from this apartment complex, and new urban infill projects that are kind of marching in this direction every single day.
Absolutely. So some of the outcomes that we've already had at Tanara just in the last about 2 months that we've owned it is several of our new leases are now at 1,525, up from an average lease rate of 925.
Just a staggering change there. And the biggest change for that, or the biggest reason for that is kind of clever. But about 20 years ago, the owner had an asset that had been basically unrenovated in 30 years. And said, older people, they like those kind of older finishes. So we're going to just make this a 55 and older community. And at the time, Tacoma had a lot of, that older workforce demographic. So that made a ton of sense. Fast forward 20 years, Tacoma is now kind of a young, hip community. That's just not a demographic thing that makes sense anymore. And we still have all these classic finishes, these unrenovated units for half a century. So we're just kind of getting rid of that 55 and over covenant and slowly bringing in that younger demographic that's really excited to live in this incredible A+ location. So we've done kind of a light renovation. Our heavy value add product, that's going to be kind of a 90-day turn time. So we're basically going in, and in a few days, in less than a week, we're able to make these units shine to a certain extent, and then bringing in that younger demographic has allowed us to basically push rents 60% just in a couple of months, and improving the common areas. There's a million little things that we've already improved about this community that's just made a night and day difference. We're escalating in place rents, so we've had about 106 out of 130 escalations already go out. For every one person that decides to vacate, 7 people decide to stay. This asset was just so far behind market rent that even with a $200 average escalation, they're still getting, they're hundreds of dollars lower than they'd be able to find housing anywhere else. And with all the improvements we're making to the community, people are excited to stay there and continue to call it home. So just staggeringly impressive, I think anyway, improvements and outcomes that we've had in the short time that we've owned this asset.
Very excited to continue our renovation project here. So this will be a large, many-year, multi-phase renovation project. When I spoke about cash out refis, I mentioned that sometimes when our renovation projects are so large, we will do phased cash out refis, and that will happen for Tanara. And the reason we do that is to get that initial equity back as quickly as possible to get to an infinite rate of return. But then, of course, as we continue to generate more value in the future, we want to share that out. And that's the years when you would get a larger return in future cash out refi years.
Yep.
Let's hop over to Douglas Trail. That's right here in Rochester, Minnesota. We acquired this just a few weeks ago. This is a 100-unit townhome community. We acquired this because the seller had a variable rate loan in place and they could no longer service their debt as rates had gone up. So we were able to acquire this at the price that they paid in 2017, So we're essentially getting like a 5-year head start on the real estate appreciation that has happened over the last 5 years. And then we were able to place fixed rate debt. So we placed 5.15% fixed rate debt for 5 years through working with local regional banks. One thing that's really important to note for our business model is 100% of all of the debt on everything that we own in all of Fund 2 and everything else we own, all has fixed rate debt. We don't have any variable rate debt anywhere in the portfolio. And we work with local regional banks where we have a personal relationship with those folks. Nick and I sign full recourse on those notes if that's needed to get the most favorable terms. To date, we've signed full recourse on everything. We do that because we believe in our projects. We're very conservative with our underwriting. You'll hear us say time and time again, we're very conservative with our underwriting. We're very incentivized to be conservative with our underwriting because we are signing recourse on the debt. So we absolutely have to make sure that we're going to hit the projections that we target. And that's how we're able to get such favorable debt.
Yeah, in a typical private equity fund structure, the fund manager might put in a very small amount of capital, but almost never will they agree to sign on recourse for the note. So just make sure everyone understands kind of the scope of this thing. Basically, Elaine and I are vouching for this asset. If for some reason this asset was repossessed by the bank and there wasn't enough value in the asset to cover the debt, Elaine and I are on the hook for that. So that's a very big deal. So we just signed our names to an $8 million loan just for this one asset. So it's a tremendous amount of risk that we're taking or collateral that we're putting into the deal that most fund managers are not willing to do. If we were to go get a non-recourse loan on this particular project, well, first of all, I don't think we could get a reasonable loan at all because the asset wasn't performing. It's a distressed asset. Most of the things we buy, there's a problem to solve. There's an opportunity to create huge value. That's why we want to buy it. And when we go get a full recourse loan, working with a regional bank we have a relationship with, essentially the bank is saying, well, the asset isn't great, but we really like the Stoggebergs and we really like their balance sheet and their reputation and their track record of success. So if we were to go get a non-recourse loan on this thing, maybe we'd be getting like a 50% LTV instead of an 80% LTV. Maybe we wouldn't be able to get construction financing, whereas we got 1.2 million of construction financing included in the loan. And maybe we'd be looking at like a 7.5% interest rate instead of a 5.15% interest rate. And we'd have all kinds of points on the front and the back of the loan. So when you go out and get a non-recourse loan on assets like this, you get just categorically inferior terms. Elaine and I really believe in the projects that we're doing here with Fund 2, and that's why we sign on a loan. That's how we get such incredibly good debt on these assets.
We've already had a full cash out refi offer from HUD at 13 million. So even before our value add plan, before our renovations, just to speak to, when HUD underwriters who are typically very, very conservative, looked at this project, they realized that, having purchased it at the purchase price from 2017, we were walking in with a lot of day one equity. We chose to work with a local regional bank so that we could do our value add project because we have big goals and big plans for this community. But that speaks to the security and the equity that we're acquiring on day one. We've already closed on this asset.
Your eyes don't deceive you. We're projecting a 17% cash on cash rate of return, and we will achieve that within the next 12 months. And on the next slide, I think we've got some of our outcomes so far there.
Yeah.
We've already renovated 6 units where we have in process. We've got one complete. I think a couple maybe have completed here in the last couple of days since we drafted these slides. And we're going to be in a situation where we're going from $875 a month for a 2-bed to $1,250 per month. And then for a 3-bed, we're going from $1,050 a month to $1,400. We've already proven 6 leases at these new lease rates. It turns out that people love having a high quality place to live, and the rental rates speak to that success just by itself. People, if you want to know how someone feels about something, tell them to put money on it, and that's exactly what these tenants have done with these proven leases we've already been able to achieve in the very short time we've had this asset.
It's important to note, too, that we closed on this asset in November, which is tough in most places in the country, but particularly in Rochester, where it gets very cold and it's very dark. And so that we're able to achieve these outcomes makes us very excited about what we will be able to achieve in the leasing season, which for us starts in like late March and goes through early September. Yep. So just couldn't be more excited about the outcomes that we've achieved in just the first several weeks of ownership, both in terms of the renovations and in terms of the leasing performance, and very excited about what is to come. The next asset is the Riverview. This was a $5 million acquisition, another opportunity for us to acquire the deal because the previous operator was struggling. They were operating this as a short-term rental and really just kind of didn't have their operations together. So the lender came to us and asked us to acquire it so that they could get this asset off of their books. We were very excited to do that. Coincidentally, we acquired this also at the 2017 price. It's completely coincidental. The deals came to us from entirely different groups and entirely different banks. But again, very excited to have kind of a 5-year head start on, appreciation of this asset. Because this was operated as short-term rentals and our business model is long-term residential real estate, we've been able to wrap up those folks' stays. We're not booking any additional stays. And then we have 15 units that are already in renovation because we're able to vacate those units so quickly. So just a 15 of our, we have 54, 57.
39.
Our 15 renovations.
Yep. So we have 65 renovations that are in flight as of today.
In the company overall.
20 of those now, we're up from 15. 20 of those are at Riverview.
Yep. So very excited about the speed at which we were able to make progress at this asset.
We're going to get our entire team together. So we have like 23 full-time employees now. So these are all furnished, short-term rentals. And so there's furniture in a ton of these units. So we're going to get the whole crew together, get a bunch of trailers to go defurnish these units because we're able to turn them over so quickly, which we love. We love being able to execute our business plan so quickly. But just to speak to the ferocious pace at which we're executing our business plan, we have 50 beds and 50 sofas and stuff that we need to vacate from this premises. We're gonna have a big furniture moving party here this week.
Our financing on this asset is also wonderful. We have fixed rate debt at 5.15%. And then we also were able to negotiate a 10% seller carry with no interest and no payments for 5 years. So when you average that together, our interest rate is under 5% fixed for 5 years and no payments on that seller carry portion. So that helps with, getting that return of capital even faster. We have a little over a 16% cash on cash projected for year 1. It's important to note that in our cash on cash projections, again, kind of going back to when we talked about how we do our projections for the fund, for cash on cash, we always speak in year 1. Mm-hmm. Our belief is that anyone can take an asset and look at year 5 and send out very rosy figures that look very exciting. Well, that's just kind of how real estate works for all of us. If you just kind of take, basically good care of it. Really, year 1 is a very important year. And for us, we're looking at, is there a clear opportunity to drive a large amount of equity to get to a payback? And then what is the cash on cash? And so in this one, it's 16%. Let's go back to Douglas Trail is 17%, and then we'll talk about the others as we go along. But that helps with security. So what that does is it helps to fund renovations, and it helps to get to that stabilized period about 1.5 years into when the fund opens, that we're able to start doing cash flow distributions back to investors.
Yep.
Very excited about Douglas Trail. Our next is Residences of Old City Hall. So this was also a $5 million acquisition. This is here in Rochester. This was the Old City Hall of Rochester, a very grand building built in the 1920s. The windows here, I always encourage people to kind of take a look at the flagpole and then, kind of move that down with your eye to give you some sense of the size of the windows and the size of, this is a 2-story building. And each level is like 25 feet ceiling. So very, very beautiful, like multiple layers of crown molding throughout, custom light fixtures all throughout. A really interesting, really special living experience that's unlike anywhere else. So, we're really proud of our townhomes and our apartments. We really believe that we renovate them to be, excellent quality. We really think of like an owner occupant standard in our rental housing. But this defies all of those. This is for someone that wants to live in an apartment for maybe convenience reasons or not having to deal with lawn or snow or location. This is walkable right to Mayo Clinic, but wants to have a very special living experience. That's this building. This was converted to an apartment building in the early 2000s. That adaptive reuse project was done extraordinarily well, putting individual HVAC in every single unit, individual electric, really turning this into a true apartment building. This isn't what Nick and I kind of call like a Franken building where it was kind of hobbled together. It's the
most exquisite adaptive reuse we've ever seen.
Yeah, I mean, outside of, how grand it is, you would never know that it wasn't built to be an apartment building. And then they did, rather ho-hum finishes on the interiors of the units, which was a wise decision at that time to spend the capital on the immutable parts of the building. And so we're excited to come in 20 years later and do renovations on the interiors of all of the units, so that when you have that experience, when you're walking into the common areas, when you're walking up to your particular unit, and then you go into your unit, it all matches. It's all that premium feel, that very exciting feel. We were able to acquire this. Really interesting financing on this one. Just couldn't be more excited about it. So we negotiated half of the purchase price as a seller carry with no interest and no payments for 5 years. That made a lot of sense for this seller because of his individual tax situation. And then because we were walking in with so much equity, the bank financed the rest, and they did so with only $500,000 down. So only $500,000 of the entire fund size went to this asset. And then even better than that is our construction escrow. So as we complete our renovations, we just draw out that $500,000. So kind of depending on how you think of it, like you might think that the fund acquired this for no money down because we're drawing back out that $500,000. So very, very secure financing is really going to help us with getting our construction done as quickly as possible, and getting to that cash out refi as quickly as possible.
Yeah, I mean, with such ridiculously favorable financing, we're going to hit a 25% cash on cash rate of return in year one alone. So we'd get a full return of capital just from cash flow with no cash out refi in the next 4 years. In terms of individual unit performance here, we've already renovated one unit, and it leased out before we even completed the renovation. Right now, we're just doing kind of like a light renovation pass to, some of these rents are so low that and there's just such low hanging fruit with the renovations that we're able to turn these over very quickly, and that's kind of a phase one renovation that makes sense. The in-place rent on this unit was $1,600. We thought we'd be able to get to $1,800 after a light renovation. We ended up getting to $2,100 per month on this particular unit. There's other units that are at like $1,100 per month, and we're confident, based on this one data point we have so far, we're going to get to like $1,800 per month on those units after just a light renovation. Just bringing these units kind of up to par with the grandeur of that building, kind of matching up the color palettes and design themes. We're going to be able to make huge improvements with these units.
Yep, very excited. This renovation here, we did this in just a few days, and this is a very light renovation. So we'll be taking out the countertops in most units, putting in backsplash, doing the bathrooms in addition to the kitchens. This one we just wanted to move quickly to cure some of the vacancy at the building this time of year.
Yep.
Hampton's Townhomes is a really simple project. We didn't even do an individual webinar on this one. This is a $1.5 million 12-unit townhome community, the kind of thing that maybe you typically wouldn't find in a syndication or fund because it's not large enough to justify all of the legal and accounting complexities that come. But in our fund model, it works really well because we have the capital sitting in the bank, we have the property management company, we have the renovation crews, and we kind of think of these smaller communities and even single family homes as like little money machines. So we can acquire them, do all of the renovations very quickly, drive up the value very quickly, and increase the velocity of capital so that as we're doing those larger projects, like say Tanara or Douglas that are 100 units plus, the velocity of capital is quicker with these smaller projects. So just 12 townhomes. You can see here it kind of takes up like a whole city block with the 3 buildings and then the 3 garage buildings as well. We like that it has a nice community feel. There's enough lawn space and everything that it really has just a community feel. There's really no better word for it, despite being only 12 units. We very similar, to what you're seeing with the other acquisitions in Fund 2. On the bank side of the debt, we have 5% fixed for 5 years, and then 25% of the purchase price was carried by the seller with no interest and no payments for 3 years. We anticipate a cash out refi in as little as a year because this is just such a fast renovation. I mean, we may have this renovation done in, I don't know, 120 days or something like that. Very, very quick here. And then our projected cash on cash for year one is just a hair under 17%. So this is kind of a bread and butter sort of very simple deal for us. Fund 2 will also own a portfolio of single-family homes for that exact same reason. We have an excellent acquisitions team. We're able to renovate them very quickly. We're able to manage them very well and achieve premium rents. And then we're able to move that capital very, very quickly. For Fund 1, as an example, Fund 1 has acquired 30 single-family homes, renovated all of those homes, and completed a cash-out refi on all of those homes in less than 1 year. So that's kind of a similar projection of what we would have in Fund 2, and it helps to smooth out capital as we're doing these much larger projects as well. Those are all of the deals that have closed that are already in the fund. The next 2 that we are going to talk about are under contract. We have every reason to believe that these will close by the end of 2022. Green lights everywhere we look in terms of financing, contracts, due diligence, all of those things. But these are under contract. So the first is Residences at Discovery Square.
Yeah, so this is, I would say, going to be kind of the other cornerstone of Fund 2, along with Tanara Villa in Tacoma. We're unbelievably excited about this. So this is a Class A urban core asset. This thing is massive. It's an entire city block. They had to knock down a large number of houses, put together a large number of parcels to put this asset together. And the reason why there's a value add opportunity for us is it just had some unfortunate timing. It came online in December of 2019, so it really struggled to fill up. Kind of coming online as we went into the peak of the pandemic. It's an older seller. They're in their 70s and they're just ready to sell. They're at a point where the building is full and they can get a decent price for it, not a premium price, but a decent price for it. And we're happy to buy it because there is still so much value add potential left with this building. They have kind of depressed rental rates from that initial lease up, and we know we're going to be able to bring those rates up to market rate commensurate with our other downtown buildings. And then the really cool thing is the entire main floor of this building. So literally an entire downtown city block. It's all currently just a white box. It's a blank canvas, 20,000 square feet of space. We're going to install between 9 and hopefully as many as 14 urban townhomes on the south side of that building.
Those slides while you're talking.
Yeah, so just some pictures of some of the interior finishes there, and then here's some architect renderings of what we plan to build out. So we already have completed architect renderings. Zoning and planning is good to go. All the city approvals are good. We just need to pull permits immediately after closing. We'll spend about $2.5 million we anticipate on building out these units and other commercial build outs, and then we'll have essentially three commercial spaces left to fill as well. So just a massive value add potential to go with this particular building. It's really rare to get a Class A urban core building that you can get kind of at a discount, so to speak, and have so much upside potential. The other really cool thing about this project is we're really aggressively working with the bank, with the seller, to buy this on a contract for deed to assume the in-place mortgage. So the in-place mortgage is $20 million and it's at a 2.37% interest rate. So that would be a far more favorable interest rate than we'd be able to get on new debt today. And the existing borrower is going to stay on the note, so the deal really only gets better for the bank. They get a new owner who's going to put millions of dollars of additional capital into the deal to build out that main floor. So the deal only gets safer for the bank, and then it's a good deal for the seller because they're able to sell this deal when they may not be able to otherwise sell it without putting together a creative financing deal like this. And as a result, we're going to get just an astronomical rate of return. We've got some pro formas here that we can take a quick look at.
Here are the pictures of the interior of the units. You can see it, fits our portfolio very well, very similar design aesthetic to the other properties that we have in the portfolio. And then before we get to the pro forma, I just want to talk about our downtown campus. So we do the majority of our investing in Rochester, Minnesota, and Tacoma is our second headquarters. And when you're to understand Rochester, you must understand Mayo Clinic. So Mayo Clinic has two campuses, a hospital campus and an outpatient campus. And much of the real estate that we own is in the middle of those two in walking distance. So everything in the red boxes here with the little hearts, those are acquisitions that are already owned and managed by Black Swan. And then Residences of Discovery Square is this large orange block down at the bottom. So you can see it's very similar. It helps with economies of scale, with management, with most importantly with leasing. So we really want to be the housing provider for this entire area. So we can help someone if they need a small studio apartment with, maybe just themselves and maybe a cat, all the way to, large 2-bed with den apartments with, 2 bathrooms, really anywhere in here. If you want a historic building, a new building, all sorts of living experiences that, when we get that lead that comes into our property management company, even if, say, the building that they call about is full, or maybe the 1-bedroom apartment isn't the size that they were hoping for, we're able to say, well, let's shift you to any of these other options as well. So Residences of Discovery Square is part of that bigger story. And then it's also part of the bigger story of Rochester. So immediately south of Residences of Discovery Square, like less than 1 city block, maybe a 2-minute walk, is an extremely large park expansion in Rochester that's taking an 18-hole golf course and keeping 9 of the holes for golfing, but then taking the other space from the other 9 holes and really creating an all-inclusive, all ages, all abilities, all experiences, city public park with things like pickleball and tennis and a walking track and an ice rink and playgrounds for children. I mean, anything that you can imagine for an outdoor play area will all be here. Very excited about what this means for this part of the community, and then particularly that it's literally just right outside of the doorstep of Residences of Discovery Square. So let me hop over to the pro forma. There you are.
So with that existing financing in place at 2.37%, we expect to be able to get to a 14% cash on cash rate of return within the next 18 months or so. And then that existing debt will end October of 2025. And at that point, if we assume we'll get a $20 million note at a 6% interest rate, so I think we're being relatively conservative. You can see we're getting debt a point lower than that on some of these other assets. So I think we're doing some very conservative underwriting there. We'd end up at like a 5% cash on cash, 20% total annualized rate of return, but still owning a Class A plus urban core asset for a really low, down payment, essentially, with huge upside potential in the next 5 years. So we're unbelievably excited about the, return profile. Typically, a deal like this, this class of asset, you can't get this without paying kind of a staggering premium. There's an asset literally next door to this one, kind of a directly comparable asset that's transacting for like a 70% higher price than this asset. We're getting a phenomenal deal on this thing.
Yeah, very, very excited about Residences of Discovery Square and what that means for the performance of the overall fund. We're also under contract on another deal in Tacoma, Washington. We'll spend our last minute or two here going over this deal.
This is a really cool deal. So this is located inside of the Pacific Lutheran University campus. So it has this large kind of urban core feeling campus. The main building we're getting is the one kind of front and center there, that brick veneer building. We're getting 3 parcels. So the box on the right side is kind of the main building that we're interested in running our core business model on, doing a Burr business model. And then those 3 boxes on the left, those are additional parcels that we're getting with the deal. Well, here's the really cool thing. So we've negotiated a seller financing package with the seller. So we'll put approximately $1 million down on the purchase, a $4.3 million purchase approximately, but we're only putting a lien on that east building. So we can entitle those parcels on the left, those 3 other parcels. For multifamily development, they're already zoned for the highest multifamily density in Pierce County. So they have a really, really desirable, valuable zoning. We do have expertise in ground up construction of multifamily. So all we need to do is, put together a site survey and some engineering plans, do some environmentals, core samples, that sort of thing. And we'd be able to essentially sell that as a turnkey project on the market. We think we could get approximately $1 million for the sale of those parcels with that, entitlement value add that we do. And that would leave us with no money in the deal, but we still own that main building. That main building could be worth as much as $6 million once we, bring rents up to market rate and run our typical value add plan on that property. That could even be eligible for a cash out refi in the future as well. So there's just kind of insane upside potential on this particular deal, really unique deal where we've been able to put together just really cool win-win seller financing And we just got this under contract. I was just in Tacoma here 10 days ago or whatever, doing the due diligence on this asset. Unbelievably excited about this deal.
Yep, very excited. So those are the two deals that we have under contract that are projected to close in 2022. That's great from a return perspective, also great for a depreciation perspective. Obviously, we want them to close during the period of 100% bonus depreciation. So that's a wrap on Fund 2. Here's just kind of a summary slide. So again, it's a private equity fund, no fees whatsoever. 100% of capital goes back to our partners until they're completely repaid. We target a maximum of a 5-year payback period. Really, we're looking more at 3 years as the goal that we're working for. 50-50 split thereafter. It's an infinite rate of return period for like a 20 to 25-year hold period. We have 10+ years experience. We're at $1/3 billion in assets under management. Vertical integration, our property management is a big part of where we're creating all of this value. I think that is everything. It's a 506C available to accredited investors. BlackSwanFund2.com. We're down to the last, several million. So if you or anyone would like to get a seat at the table for Fund 2, now is the time. And here's the links again for our calendars. Meet BlackSwan.com. If you're unable to get a time on our calendars, if you need additional time, a night, a weekend, whatever, just send us an email at Nick@BlackSwanTeam or Elaine@BlackSwanTeam. Our phone numbers are also there. We'll make ourselves available to make sure that everyone's able to get in before the deadline.
Absolutely. We love chatting with investors, answering questions, and we're down to the wire here. So we're going to make ourselves as available as possible to connect with you, answer any questions that you might have, and we really look forward to serving you in Fund 2.
Absolutely. Thank you so much.
Thank you.